I'm back again with another video. But before we start talking about today's topic, I just wanted to say that with your guys' immense and amazing support, Stocks for Teens has officially reached over 230 subscribers. My last video, Risk Management, reached over 16,000 views in under a week. So thank you guys so much for your amazing support. I definitely couldn't have done it without you guys because you guys are my motivation. So all I ask of you is to keep supporting me, keep watching my videos, and if you're new, join the Stocks for Teens family by clicking that subscribe button, and let's get into it. I'd like to start off today with another quote from Warren Buffett. Warren Buffett once said, "Rule number 1, don't lose any money, and rule number 2, stick to rule number 1. This is so true because money is important. It's earned through hard work, whatever that hard work may be. So it would be a shame if you lost all of your money in one investment. So always be careful and cautious within the stock market." With that in mind, today's topic we're going to be talking about today is fundamental analysis. So let's get started. So as I've mentioned before, today's topic is fundamental analysis. Last time we talked about risk management, which shows investors how to avoid certain risks with certain stocks and strategies. But today we're going to be looking at how to analyze stocks before investing in them. Fundamental analysis basically sums up this research process. And before we talk about what strategies we use in fundamental analysis, let's talk about the formal definition behind it. Fundamental analysis is the process of determining a stock's real or fair market value. We do this by examining a company's financial statements to help decide if the company's stock is a good investment to make. Fundamental analysts study any factors that can affect the stock's value, whether it be through macroeconomic factors such as the general condition of the economy, or microeconomic factors such as the effectiveness of companies' management. The primary purpose, and I cannot stress this enough, is to be able to see whether or not a stock or security is worth the value it's being put out as. This is an additional piece of information, but for those of you who don't know, there's a different type of analysis that investors use to examine stocks, and that's called technical analysis. This is different from fundamental analysis, as technical analysis involves predicting price direction through historical market data such as previous price movements and volume. Now, let's take a look at the 3 different financial statements investors look at during fundamental analysis. People in the stock market typically look at the income statement, the balance sheet, and the statement of cash flows in order to analyze a company's stock. Of course, there are other financial statements that I haven't mentioned here in this slide, but the 3 that I've mentioned here are specific to investors and traders in the stock market because it shows why specific prices are set for specific stocks. The first financial statement we're going to be looking at today is the income statement. The income statement reports a company's financial performance over an interval of time. It includes the company's revenues and expenses to show whether or not the company has enough revenue to cover its expenses. The equation revenues minus expenses equals net income represents the income statement as a whole. If the difference between the revenues and expenses are positive, that means the company has a net income, and if it's negative, then the company incurs a net loss. Here's an example to make things easier. Let's just say a company has a revenue account of $100,000 and expenses that total up to $50,000. Then the net income price would be $100,000 minus the $50,000 of expenses, which would be $50,000. In this case, the company made a profit of $50,000 because their expenses were $50,000 less than their revenue. If the company had let's just say, a net loss of 50,000, which is negative 50,000, that means expenses overtake revenues in this case, showing that the company is not profitable and showing that it's an indicator that you should not invest in that stock. The income statement is important to look at because it tells if a company is making profits or not. This is something to look at when investing in a company because a company that's in profits year after year is worth looking at because their expected dividends is going to be high. If they are not in profit, then that presents a red flag. Next is the balance sheet. The balance sheet reports a company's financial position at a certain point of time, unlike the income statement, which shows a position during a period of time. This statement includes assets, liabilities, and stockholders' equity. If you guys don't know what those terms are, then don't worry, I'm going to explain them to you right now. Assets are pretty simple to understand. They are resources owned by companies, and they have future economic value that can be measured by a dollar amount. Examples include cash, land, buildings, and really anything that the company owns and purchases. Liabilities, on the other hand, are whatever a person or a company owes to another organization, usually a sum of money. Basically, a liability is an obligation. Finally, the last term you should know about is stockholders' equity, which is the remaining amount of assets available to shareholders after liabilities have been paid. This is the most important piece of information to look at on the balance sheet because it represents how much is available to investors as dividends. When investors notice a lower stockholders' equity, they should know that the company's stock is not profitable because investors are only getting a limited amount of dividends from that company. A company with a higher stockholders' equity is a company worth looking at because they can distribute more dividends, therefore increasing profit for stockholders. The basic accounting equation, assets equal liabilities plus stockholders' equity, can represent the balance sheet as a whole because it shows the total amount of assets, liabilities, and stockholders' equity the company possesses. Therefore, the balance sheet adheres to this equation. Here's another example just to make it simpler on your guys' behalf. Let's just say that a company once again had assets that's worth $100,000 and liabilities worth of $50,000. So $50,000 of that company's assets would be dedicated to paying their total liabilities. The remaining $50,000 of those assets would be treated as stockholders' equity and would be paid off as dividends to the stockholders who own a portion of that company. The last statement we're going to be looking at today for fundamental analysis is the statement of cash flows, which measures activities involving cash receipts and cash payments over a period of time. There are three categories in which all cash transactions are classified, and that's through operating, investing, and financing. To understand what to look at in the statement of cash flows, we first need to understand a little bit about the three different categories. First, operating cash flows include cash receipts and payments for activities reported in the income statement to calculate net income. To make it simpler, operating cash flows are the amounts of cash generated by a company's normal business operations. Let's just say you had a toy company, and the way you make revenue and income is through selling toys. Selling toys and the cash flows that come from selling toys is the company's normal business operations, so that would be classified as operating cash flows. Financing cash flows include transactions for the purchase and sale of long-term assets. For example, a bank loan is considered as a financing cash flow because it helps finance business operations. Finally, investing cash flows are really anything that involves transactions with lenders and with stockholders, such as issuing common stock and paying dividends. Investing cash flows are really what investors should look at because this is related to the issuance of stocks and dividends. The total net cash flows from operating, investing, and financing activities equal the net change in cash during the period. So this equation is associated with the statement of cash flows, the one that I've listed right here. The statement of cash flows is important to look at because it shows how a business uses its cash to operate the business and make investments. As always, thank you once again for watching. I know I only started this channel about a month and a half ago and that it's relatively new, but the amount of support I've been getting is incredible, so thank you once again so much for watching. Just a heads up, this video, Fundamental Analysis, is actually a part 1 of a 2-part video. I only covered about half of the material in this video, and in the next video I'm going to be focusing more on how to simplify the process of fundamental analysis by looking at specific and important ratios. So please go check my next video out. I'll be posting it in about 2 weeks, so go check that out. As always, don't forget to like, share, subscribe to my channel Stocks for Teens, and leave comments. I'd love to hear your guys' questions about any content that I cover, or leave suggestions for future content material, because that would be greatly appreciated. But if not, then I'll see you next time.